Hello students, a very warm welcome to CB1's first technical class of CB1, where we will take up the first chapter, which is chapter 9. Out of 22 chapters, we are starting with accounts, and chapter 9 deals with introduction to accounts. Introduction to accounts. Here in this chapter, our prima facie objective is to learn why a company prepares accounts, why they prepare accounts, and what is the end use, how do they use it, and also why you as an actuary need to know this chapter. Okay, we will keep it extremely simple so that whoever you are, some of you could be from science background, some of you could be from commerce background, some of you could be from arts background. Of course, usually in humanities people do not have maths, but even if you have, then if you've taken up actuary, your knowledge is zero. I am presuming that you do not have any knowledge on what is a company, how does it operate, what are the legal requirements, what is the entire landscape in which a company operates, and what is required from a company. So, presuming that you know nothing, I am starting and stating everything afresh and anew so that it helps you. Okay, let us quickly see what is a company. What is a company? Okay, so by now, whatever practical exposure to business you have had in your lives, you must know that business could be done in manifold forms. Some of the forms are sole proprietorship, then there is partnership, and then there are big companies or small companies, doesn't matter, there are companies. So, these are the three preferred vehicles or ways of doing business, right. So, sole proprietorship deals with a proprietor, an enterprising person who is doing his own business in a very limited format, which is known as proprietorship. There is no separate legal structure or entity created in order to do his business. So, he is the sole businessman, he is the sole person, he is the sole proprietor. So, he is himself legally liable for all his dealings and all his business transactions. Whereas, the same thing if he does with another partner, it becomes a partnership. So, in both proprietorship form of business and both in partnership, also in partnership, there is no separate legal entity of the proprietor or the partner. They and their businesses are the same thing. They are the same thing from the legal standpoint. But if we talk about companies, they stand out. How, sir? They stand out with respect to the fact that companies have a separate legal entity of their own. That is, the company has a status which is separate and distinct from that of its members. Company and their members have separate legal entities. So, members of a company and the company are not legally one and the same. In case of proprietorship, they have same. In case of partnership, the partners and the firm are viewed as the same legally. But in case of companies and its members are legally distinct. So, that is the first chief feature and the first distinction and the first thing which makes a company different from the other two. Okay, now let us talk about the other aspects. Okay, now if you talk about liability, usually a sole proprietor's liability towards the business is unlimited. Liability is unlimited, and similarly a partner's liability is also unlimited. What I mean to say is, when a proprietor is doing business, if the assets of the business are not sufficient to make up for its liabilities or to meet its liabilities, then the proprietor is personally liable. Whereas if we talk about partnership business, there also it is the same, that is the liability of the partners are unlimited liability. They will be personally held liable for any losses in the business. They will have to bring in their personal wealth and make up for the deficiency in the partnership business. Whereas in a company's members, their liabilities are always limited, and hence companies also differ from proprietorship and partnership from the perspective of liability. The members' liability towards the liabilities of a company is always limited. They have limited exposure, limited risk and limited liability. So these are the two chief features of all companies globally. If we talk about global, any nation, any region, you talk about 90% of the companies are like these, where them and their members have separate legal entities and their liabilities are limited. Okay, so that's about a company's basic structure. Now let's go back to the context of this chapter. Why a company needs to prepare its accounts. Now let us talk about how a company is formed. First, let us understand. Okay, so let us understand the landscape first, and then we will in detail try and understand this chapter. So every chapter, if we approach in a method or in a manner whereby we have the grassroots understanding and the background, and then we form more understanding through the chapter, and then we go back and read and we enrich ourselves with the total knowledge of the chapter. So I am setting the background. I like to talk in detail. So this CB1 chapter becomes a challenge for students who who find commerce and commercial finance, accounts, all these papers challenging. For them, for their nourishment, which usually commerce background people get 3 years or 2 years of nourishment, for students of science who do not have that much amount of nourishment, for them I am trying to give them the alternative food through so much of depth exploration, I call it. Okay, in-depth talks. Okay, now how a company is formed. Let's talk about how a company is formed usually in any country. Okay, if I talk from the perspective of India, although I'll talk from the perspective of UK only mostly, but let us, for this example, let's talk about India. Okay, so my background, I am a CA, so you can understand many clients come to me and they ask for why don't you form a company for me, sir? So I help them with their company formation. So how do we form a company? How do we form a company? How is a company formed? Okay, so firstly we ask for a preferred name of the company. Then after that we ask them that who are going to be the directors, and for the directors to be eligible, they need to have a DIN and DSC, and then we will upload forms on behalf of the company with the signatures of the directors, registration forms and everything, and there are memorandums and articles of a company which we will draft and upload them with the website of Ministry of Corporate Affairs in India, MCA, and MCA will get back to us with a certificate, and that certificate will constitute our incorporation. That certificate will have a number called SIN, CIN, certificate of incorporation number, okay, corporate identification number, I am sorry. So that SIN will be used by us in and will be quoted in all our corporate, you know, legal requirements. And this is how a company is formed. And a legal person, a company is a legal person who has a different, you know, existence in the eyes of law from that of the members who have formed them. These are the members, let's say. Okay, so these members are separate, and this company which is formed has a separate legal entity. Both are separate. Okay, so this is how a company is formed. Now, right after a company is formed, if it is a public company, a company could be a public or a private company. Now, when we talk about private company or public company, what do we mean? A private company usually cannot issue securities to public in general. A private company cannot issue securities to public in general. Now, what do we mean by securities? Securities are basically instruments used by a company to raise capital or funds from the market. For instance, if a company wants to raise funds or capital from the market, it will issue share capital to the public. So, a public limited company can only issue securities to the public. If you are not a public company, you cannot issue securities to the public. You can only and only, you know, issue securities to a limited number of members whom you can have on board. Okay, so there are two types of companies which could be formed, a private company and a public company. Let's say the above company in the example which I was showing is a public company. Let's talk about a public company. Usually public companies are big because they can issue securities to the public at large and in general, and they will be once the securities or shares are subscribed by the public will pay towards the share capital of the company, and that's how the company will grow phenomenally, exponentially. And a company's growth, with the company's growth, the number of members and the stakeholders in the company is also growing. Okay, now what I am trying to say, let's connect. So, a public company will have numerous or many shareholders and members, and let me tell you, a public company has numerous shareholders. Now, this public company is also accountable to them. Accountable to whom? These numerous shareholders, because they are putting in money. They are putting in money. Okay. Now let me tell you how a company is run. Let us understand the landscape. The full landscape, if it's clear to you, then it will become very easy. Everything, if we go slowly and try and grasp the concepts at the grassroots level, then we build up on them, we become stronger. So, I am trying to lay a very strong foundation here. So, like I said, there are numerous shareholders, numerous stakeholders, numerous members in a public company who have, you know, put in their money to the companies, with the companies. And the company in turn is accountable to every such member who has put in their money, Now, as a part of this accountability, let us understand how a company is run. A company is run by a board or a group of people known as board of directors. Company's management, the management of a company, that is management of the day-to-day affairs and the overall management of the company, is entrusted with a particular group who are elected by the members only. At a meeting of a company, by the members only they are elected, and this elected individuals are collectively known as the board. The board of directors decides the fate of the company and decides all the management decisions taken by them. Okay, so this board has a duty towards the members who have elected them, and has a duty towards the company also. So they have a duty to publish the financial results of the company, along with the financial position, Okay. In order to do this, they must prepare and present the financial statements, FS, or we call it financial statements of a financial year. And this is what happens in the company. So no need to worry, all these terms and jargons are becoming very simpler. So the board, in order to ensure transparent accountability or accountability in a transparent manner, the board will publish the financial statements. In order to publish the financial statements, they must take care of the accounting, and that is why accounting is done, or rather financial accounting is done. It is the duty of the board or the management to ensure that the company is accounting very finely, and so that diverse companies do not account for transactions in diverse manner, in order to have a standard in the society, in the world of reporting, in the world of accounting. The accounting bodies around the world issues accounting standards. So these are accounting standards. Basically, accounting standards are standards which will standardize the entire language, universal language of the accounts. Okay, now accounting standards are globally issued by different accounting bodies of the different world, different nations, and there is one single accounting standard which we are trying to set as a global standard, which is known as IFRS, if you heard. I am also an IFRS certified teacher come professional. Okay, so IFRS is another standard which basically will ensure that we have universally one global accounting standard, which is right now yet to be adopted by all countries. For instance, India hasn't shifted to IFRS yet. Okay, and I tell you these directors of several companies, of all companies, will follow the accounting standards which are applicable to their companies and report in that financial language. And as an actuary, as a professional, you need to interpret the financial statements, and for interpretation of financial statements you need to know the bare minimum language of accounts, and that is why this chapter, Introduction to Accounts. Okay, all right, let us delve further into the further depths. Now let me tell you, if I am a director of a company and you are a member, I give you accounts. The account should be audited or unaudited. It shall be 100% audited. 100% audited. And audited by whom? Examined by whom? A dependent person or an independent auditor? Independent auditor. For instance, this is what CAs do. So I audit the financial statement of a company, and before a professional like you or a normal investor reads the financial statement, I audit it so that they have a reasonable assurance from us that the financial statements are free from material misstatements. So many technical language I have just thrown in, but of course I will make it easy. As an independent auditor, our task is to verify whether the matter published on the financial statement are to a certain degree true and fair. I did not use the word absolutely true and fair because there could be errors and other mistakes which cannot be detected through audit also. That is why we give a certain degree of assurance. We call it reasonable assurance. Okay, so that's why the financial statement shall be audited, and that is the utility of audit, shall be audited every year. And all these are the entire landscape in which a company operates, and in which we, by way of which we deal with a company. Okay. Now this entire thing happens through a annual report. So basically every year, most of you have seen, if you have invested in any companies in the securities or shares of a company, you will get annual accounts or annual report published by the company at the year end. Okay. So every company or the management or the directors are required to issue an annual report. And what will the annual report encompass or include or have? An annual report will have the financial statements, which will give a picture of financial position, like I said, and financial result, whether there is profit or there is loss, and they will also have the auditor's report, which will include a lot of standardized reporting, and there will be director's report. The directors will also try and communicate and report on certain matters they are statutorily required to report. So this is what annual report will have majorly, apart from other things, other minute things will be there, but this is the major constituents or ingredients of an annual report. All right. So that is number one. Now the accounting framework. Okay. So let us talk about the accounting framework. Let me tell you, globally across all countries or most of the countries, we see that the financial statements, I use the term financial statements, the financial statements comprises these things. Which things? I will tell you, just a moment. Comprises these four things. Which are the four things which are constituents of financial statement? So in order to facilitate, in order to give you a picture on the results, on the financial results of a particular financial year, we prepare statement of income or income statement, or we call it statement of profit and loss. Statement of profit loss. Okay. This is number one. Out of the four constituents, this is numero uno. Okay. Then we have, in order to facilitate and tell you about the financial position, we prepare something called statement of financial position, SOFP we call it in short, statement of financial position, which in many countries and most commonly we call it the balance sheet. Even a non-commerce student has also heard of this statement, balance sheet, which is nothing but the statement of the financial position of a company. It talks about basically what are the assets and what are the liabilities of a company. Okay. We will go into it, everything we will go in detail, so that you have a complete picture of what happens and what does not. Okay. Then we have two more statements. Which we have to publish, a company has to publish. One is the cash flow statement. And the other one is statement of changes in equity. So These are the basic 4 things. These are the basic 4 things which a company will have to publish in its annual accounts, or what we call is financial statements, and financial statements are these 4 things. So, we have a shortened name for SOPL, we call it SPL. We have a shortened name of balance sheet or the statement of financial position, we call it SOFP. We have a shortened name for cash flow statement, we call it CFS, and we have a shortened name of abbreviation of statement of changes in equity, we call it SOCIE. So, these are the 4 constituents of the financial statements. Okay. Now, as an actuary or as an user of financial statements, what do you get by studying these 4 things? In the SOPL, for instance, they will have all incomes earned during the year against all the expenses earned during the year. So, if all the expenses for the year and or all the yearly revenue are mapped in a particular statement, what do you think? What will you get? The profit or loss for the period. And that is exactly what we get from the PL. From the study of the PL, we get what is the profit or loss for a particular financial year or a particular accounting period. Okay. And also, for further analysis, you can see what are the sources of the income. And if you do a comparative study from this year with the past year's SPL, you get to see the growth in revenue, growth in profits, growth in expenses, shrink. So, everything could be analyzed. Okay. So, that is the importance of SPL. Now, let us talk about SOFP, the balance sheet. The same thing, the assets and the liabilities, whether the sources of capital have changed, whether the reserves have increased due to the profits, whether the assets value have come down or gone up, everything you can get a synopsis and a picture through the balance sheet. That is the positional statement. And the first one is an income statement, flow and position, because the income statement is based on the year, round the year activities, and statement of financial position will give you a picture on a particular date, let us say the closing day of the accounting period. And another flow statement is the cash flow statement, which goes on to explain an user of the financial statement that how the entire cash flow of from the beginning of the period to the end of the period has changed. And lastly, we have statement of changes in equity, that is, what are the changes which are taking place in the equity, which is a part of the SOFP. We will come to that a little later in the chapter when we do the class. Okay. Now, I have used this term users of accounting information. I have used this term users of accounting information. Now, who uses accounting information? Let us start and identify the user groups. So, there are 4 user groups of accounting information. There are 4 major users of accounting information. Okay. The 4 major user groups are understood as the equity investors. Are the equity, number 1 user is equity investors. Okay. Number 2 is loan creditors. Number 2 is loan creditors. And then we have employees of the business. I will talk about why each group is interested and what they are interested in, and then we have business partners or contacts. So, there are 4 user groups. These are user groups of users So first group is the equity investor, or the person who is investing his money in a business. If I am buying the equity shares of a company, I am interested in the, stakeholder, to become the principal stakeholder in the company. I am interested in becoming its owners. Why? Because an equity investor is taking maximum exposure and the most risk. Because let's say a company is raising money by borrowing funds from the bank. Let's say it has also raised money by issuing equity shares to investors. Now let me tell you, when a company will be dissolved and wound up, firstly its assets will be sold and its liabilities will be paid off. Who will be paid off earlier to shareholders? Everyone. All the liabilities will be paid ahead of the shareholders, and the shareholders have the residual stake in the company. Now what do I mean by residual stake? Let's say a 500 crore company, or a company having 500 crores of assets, or 500 millions of USD value or worth of assets. Now such a company has let's say 300 million equity and 300 million borrowed capital. So I am giving you an example. Let's say a company has equity capital as 300 million and they have loan from external agencies or banks another 300 million. Total funding is of 600 million. Total funding is of 600 million. Now this company which has 600 million of capital, let's say this company is, has assets, it had assets of 600 billion, but right now the values have gone down, it has suffered losses and its assets only value 500 million. Now how will it be paid off? Let us try and understand. This first 500 million out of this 500 million, firstly 300 million will be paid off to the loan and as an external liability. So the loan capital is an external liability, and later on the remaining 200 will be used by repaying the equity one. So in the preference, who is getting preference? The external people than the internal people. Okay, so that's number one. Okay, now let us try and understand why they are taking maximum risk. Okay, why they are taking maximum risk? Okay, how and why they are taking maximum risk? Let us understand. Equity wale, the equity investors, they are taking maximum risk because if this 500 becomes 400, then or 300, let's say worse, they won't even get a single money back. Since they are taking most risk, the company shall ensure that whatever excess profit it earns goes to them. That is the equity investors, and that is why they are very much interested in analyzing the accounts of the financial statements. Now let's talk about loan creditors. If we talk about loan creditors, let us try and understand what loan creditors, how they can help. Okay, let us try and understand how loan creditors can help. Now loan creditors, if we talk about, they are the same as I showed you, this 300. They are this 300. Okay, now loan creditors and equity both have a stake or both have interest in the financial statements, in reading the financial statements. Okay.